Alright, hi everyone, welcome back. If I'm being so for real right now, guys, I am actually really glad that I am just scheduled to just film this today. Oh my gosh. Because my morning started pretty rough, and I don't know if you guys can notice, but you could actually tell for once in my video right now, it's actually daylight, like natural lighting. It's not my regular studio light, bless. So my morning started pretty rough because I somehow literally spilled my favorite hair detangling spray from Japan. And for those of you who don't know, Japan has like the best hair care, like oh, but yeah, it's been one of those mornings. I thought it'd be good to wake up early to get my day done faster, but ooh man, that was a hit. But honestly, I'm really happy I get to sit down and talk with you. I usually record my podcasts in the afternoon or at night, so I love this new natural lighting setup. But then after that, life do be humbling me a bit. But anyways, I'm excited to be here with you guys and just yap about one of my favorite special interests, which is financial literacy. And hopefully this topic today will make it seem a little less overwhelming. So let's get on right into it. Oh, also a tiny cozy detail, I don't know if you noticed, but I have my Animal Crossing sweater I got from the Nintendo store in Japan with me. Yes, we are talking about bells and finances, so I thought it'd be fitting to wear some Animal Crossing wear. Because honestly, Animal Crossing was like the first ever game that low-key teaches about like money and saving, loans, and there's even mortgages in there. That little like 10-year-old me who probably was playing like Wild World on the DS had like no idea what that meant until today. And of course being in debt to Tom Nook, which is, hey, that's the most relatable thing ever. So I make this a thing and so maybe I'm thinking of just making this a thing and I'll just wear my Animal Crossing merch or pajamas when I'm talking about finances here. I think it'd be a cute little detail for this finance series. But anywho, so last episode we talked about being more intentional with our spending, especially as fangirls, when there's always new merch drops essentially, there's limited releases, and the things like these are designed to make us buy fast with the invention of social media. There's pop-up ads, there's Instagram. But anyway, so that was from last episode, and so now that brings up the next question, which is what do we have to do with the money that we don't spend and we could have a little extra of, don't need to use for our bills or our savings goals. So first I should probably say this so it helps get an idea for you guys. So I should probably say this first. I like to think of money in 3 different categories. So of course there's survival money, which is your rent, food, bills, your pet bills. And then of course there's your joy money, so basically the category we discussed last episode, our intentional like money goals essentially. And after budgeting for all of the above, so after you're doing your math, after you're paying your bills, so after your survival money, and then after you allocate your joy money, there's a third category that I like to call future me money, and that's really, I touched upon it a little bit in the last episode, and that last bit is where investing comes in. So investing is for that last category, and the money you essentially don't need right now, but it's money you want to put aside to put forward for future you. This is like even aside from like your medium term sort of goals that you may have put aside in your like HYSA funds or whatever. So this could be like beyond your Japan trip you want to go to in like a year or two. But this is more like future you, like retirement, anything over maybe say like 5 years is how I think of it. So what actually is investing? So at its core, investing is essentially just putting your money away somewhere, in this case, is putting your money into the market so it could grow over time. And you may be thinking, like, that's just like a regular savings account, but the main difference is that it grows with the money market as the economy goes up and down. So basically, instead of your money just sitting there and just accruing your own like interest, like in a regular like HYSA account, it's actually working actively in the background. It is moving up and down with the market. So I like to think of it like this. So saving is like just keeping your money safe in your room, while investing is like sending your money out to do side quests and come back with more money. So it does the work for you. The trade-off is that investing isn't exactly perfectly stable day to day, but over time it has the potential to grow more exponentially, and that is the key difference between putting your money aside in a high yield savings account or like saving in general, because compound interest. Let me get specific into the main big question you're probably like thinking right now, like, Naya, you just told me to put my money away in a HYSA account for the highest potential of savings rates or whatever, for the highest potential of interest and accruing more money. But actually, and you might be wondering, like, why should I invest it all and why not just keep everything in savings? And honestly, that's a very valid question. High yield savings accounts are great. They're really good for short or medium term goals, and they help your money grow like for short term, maybe medium term goals, like saving up for a mortgage deposit or something when you need cash, or of course your joy money, as we've talked about the most. But investing is different, where investing is really for long-term growth. So it's not one or the other, but you don't have to put all your money into investing, but you also don't keep all your money in savings either. They both have different roles. The way I like to picture this is that, well, okay, so for example, in your HYSA account, it is most likely accruing. By the way, if you don't have an HYSA account, you could go back and watch my podcast episode where I discuss what an HYSA is, and it's right about, oh wait, it'll be on this side. Here on this card over here if you'd like to have a look at it. But I highly suggest looking at it and opening your own HYSA account, especially because, the annoying creation of inflation. But anyway, so your HYSA account gives you about 3% APY for just holding your money in the bank. Whereas with investing, you literally get compound interest over a long period of time, sometimes faster, but otherwise but the ones that are faster, it's very volatile, so that's why investing is really for long-term you. But of course, this episode focuses on investing, so just don't close your HYSA just yet. That account still has the purpose of holding all of your short to maybe medium-term goals and cash you set aside for your joy money, convention savings, merch drops, etc. Yes, investing, on the other hand, is for long-term, for future you money. And the way to figure out like what money you are comfortable with investing, I'd like to think of this scenario. Okay, so picture this. So if your favorite character dropped a limited time figure tomorrow, would you feel stressed because your money is locked away? So as a reminder, I kind of alluded to this like a minute ago or so, but to make this more practical, step by step, your action steps are, but to recap, to make this more practical, so write down all, and to make this more practical in figuring out what is your extra expendable money. So once you sit down and do your math, do your bills for the month, and set aside the allocated money you want to put towards your fangirl goals, like, conventions, merch, all the above, that you've most likely already thought of. Watched the previous episode, of course. But yeah, so after you've paid for your bills, essentials, and you've already set aside your joy money, like your merch, conventions, and planned spending from the last episode, whatever's left over, that's the money that we're talking about. That is your future me money, aka your investing money. As in like down the line future you. We're talking like at least above 5 years. And once you've done all this math, you might be thinking, wait a second, like, I don't have that much money though. And you might be thinking, wait a second, I don't feel like I have that much extra money though. Once I did the math and add up my bills and my fangirl spending allocation and whatever other goals, I feel like I can't invest. But honestly, that is not true. You do not need a lot of money to start. You actually could do, even if you have $5 or even $1, even if you have like $5 extra, that could be invested. Because nowadays there are options like ETFs and fractional shares that let you start small. After all, I'm saying this because I am also a broke fangirl, and I also started small, and I think my first shares I bought were only like $10 worth. But let's get into it. Before I get into explaining the definitions of these terms, I would like to sort of clear the elephant in the room where you've probably heard, why should I invest if it's just like gambling? Or my family never invested and we're fine, or I don't know. Or you maybe just like me, who's a broke fangirl. You always heard about what investing is. But personally, in my own personal life, of course, no one knew what investing really was, and then I got super interested in researching for myself. So a quick recommendation actually where I learned all of this stuff from is from this book called Friends That Invest, and it's by Simran Kaur. It used to be called Girls That Invest, but they had to change the name. But I highly suggest you read the book or even listen to the audiobook. It is so helpful into getting you started and explaining all the confusing jargon, and it also has some like actual people's like investor profiles. Like they show you like the percentage breakdown of what they invest in, and it's also a really good book. It's like the one book out of like the 3 or 4 investing books I've read now that I love to reference. This is for me. Okay, my brain is not, it's not the most retainable, what's the word? I don't remember much, but this book is so good. So I highly suggest you go ahead and read it and check it out. Or even if you have the Libby app. But anyways, so going back to the podcast. So you might have heard those stories where people are like, oh, don't do the stock market, it's just gambling. There's so many stories of people losing all their money, or they had it all and they lost it all thanks to the market, etc. But the truth is, it's true, the market goes up and down. It's extremely volatile day to day. And just to be clear, no one, even the fancy day traders and all these other fancy sounding positions and people, just to be clear, no one, and I mean no one, can predict how exactly the market will behave year to year. So day to day is even worse. So if you ever hear someone who says like, oh, I do day trade, someone who goes, oh, I just get all my money based on trading stocks every day, like that, guys, is gambling actually. But anyways, so no one could predict how the market will behave year to year. Some years it goes up, some years it goes down. But research has found that over long periods of time, the market has historically trended upward overall, especially in broad market index funds or highly diversified investment types like ETFs. Which is why investing should probably be approached as a long-term thing in general, not something you check every day. And if you're the people who check every day and are constantly like buying and selling stocks, it's just not good. Nor is it good for your mental health. Like, I could only imagine. Oh my gosh. So to go back and recap, this is why investing money shouldn't be your rent money, emergency money, or money you may need soon. And that is like between, I'd like to say now and like maybe 5 to 10 years, honestly, if you want to be more safe. And this is because the market goes up and down. You don't want to be forced to take money out at a bad time. But anyway, so now we're jumping back into jargon terms. So you've definitely heard terms like stocks, index funds, portfolios, and don't worry, we'll go over those right now. But for now, basically just understand this main concept, because this will really get you through, is that investing equals long-term money that you're giving time to grow. Okay, so the smart, chill, relaxed investors are not getting rich from day trading or buying singular stocks, okay? We are not checking that every day, so do not do that. Or if you do, you only use a tiny % of your portfolio. Okay, so anyways, sorry, back to the basics of defining these confusing terms. So this is why people are talking about things like ETFs or index funds instead of buying single stocks. So ETFs are exchange traded funds, and they're a really common beginner option because they're very low barrier to entry. You could literally put in like $5, because I've done that. And basically what they are versus like other stocks, like singular stocks or whatever, they are basically a basket of companies. So they may hold things like Apple, Google, and they have hundreds of these companies put together. You may have heard a common one, especially here in the US, which is called the S&P 500, which is the top 500 companies in the US. And what you could invest in it for as little as $5, and your money will go up and down as the market does. This is why fractional shares are called dollar-based trading, because you could easily put like $10 down and then they'll do the math for you, and you could buy maybe like a tenth of a share for a fraction of what the regular cost of a full share would be, because that's what used to be back in the day, where you would need like $2,000 or something to buy like one share. Luckily nowadays the barrier to entry is like way lower for getting into investing, and it still follows the market up and down. That's just the same as a regular index fund would. So ETFs and fractional shares, are king, honestly. So just to recap, instead of buying a full share, there are things nowadays called fractional shares, which is where you can invest like in little fractional amounts, literally, instead of buying a whole stock for like a lot more money. So you could still start even if you do not have a lot of money. And while this might be seeming super rushed and maybe confusing, I really hope, like, try my best to try to make this as simple as possible.